exciting times as we head into the new year and the end of the first quarter. So this will be February's results released in the month of March. And we're looking for a little bit of a miss in expectations. However, it is supposed to be a good, strong jobs report, roughly the expectation is about 400,000 at the moment. So before we go into the presentation and see what's going on, I just want to let you know that we're having a special guest speaker as well that's going to join me momentarily, roughly in about 5-10 minutes after I've gone through some of the slides, just to get his take on where he thinks the Fed is going to go in the next few months and how that's going to affect the American economy in general. Also looking at things like unemployment rates, average hourly earnings, and things like that. And don't forget that the Canada's Ivy PMI is later today as well. So a few things coming up in that respect. So just a quick risk disclaimer before we get into the NFP. So foreign exchange trading, investment derivatives, CFDs can be highly speculative and may result in losses more than profits. Foreign exchange derivatives trading is not suitable for many members of the public. Only risk capital should be applied. This webinar is provided for information purposes only, and no information contained herein constitutes a solicitation for the purpose of the purchase or sale of any commodity, security, or investment, nor should it serve as a basis for any investment decision. Orbix Limited does not guarantee the accuracy or completeness of any information or analyst supplies. So without further ado, let's get into what we're looking at this time around. So at the moment, from the last time around, we had a very strong jobs report, even though we did see this steady decline in the number of jobs being given on a monthly basis in the American economy. However, there is, this consensus is roughly 400,000. It went up to 407,000 recently. So still looking at a very good jobs number, even if it does slightly miss expectations. However, we are looking very, very bid on the American jobs market as it is recovering quite slowly, but very surely indeed. So February's NFP release beat expectations by over 300,000 jobs, very, very buoyant there. And we're looking at the unemployment rate. It expected to be similar. It was 3.9% last time around, now 4% approximately from last month. This will be the lowest since February 2020. So, all these factors taken into place, we are looking at something very, very positive at the moment. So weekly jobless claims that I look at, because when it was the height of the pandemic, it was up to 1 million jobless claims nearly every week. It dropped down significantly to 500,000 every week. And now we're hovering just around the 200,000 mark, which is quite significant because with the recovering economy, it does give us more insight into what's going on as well. And annual inflation surging up to 7.5%. We'll look on that with Daniel shortly when he connects with us, but that's edging up to a 40-year high. Small typo there, sorry about that. So as we go into the other details, we've got retail sales in the US jumped 3.8% as well. Retail sales have been a bit hit and miss. We've gone into negative territory, then back into positive territory quite significantly. And now we're looking most likely what is the main catalyst for the reason retail sales are jumping in and out. Well, recovering economy is one thing, but when we get misses like this around the holiday season, it is quite worrying. Retail sales come out roughly over a month after the data is released. So it's pretty much before, a month before. So with that being said, as the holiday season is upon us, we got this miss, but then we got quite a big jump. As I said, this is due to the new year. Most probably a lot more people going out shopping at that time of the year as well. And private businesses, ADP figures, they beat expectations by 475,000 as well. That's quite significant because we are looking at the moment what the expectations are for private jobs. That we did get a big miss not so long ago, roughly about 6 months ago. But since then, ADP are hiring very, very vastly. Even though numbers have come down to the 500,000 mark, it's still pretty good going in that respect as well. So with that being said, I'll just go through a basket of some of the let's put this on here. This is my MT4 account with Orbex, demo one, obviously. I just go through a basket of CFD, Forex pairs and commodities just to see what the opportunities are. And so I've got euro dollar, cable, pound dollar, gold, Dow Jones and dollar CAD, and also I've got the US index, which I'll be looking at a little bit more detail because it's hitting fresh highs so far in the near term. So, after a big jobs report from last time around, we are, as I said, we are looking very, very buoyant on the fact that we are progressively moving in the right direction for a lot of the dollar pairs. We're looking at euro dollar at the moment. We're dropping below the 110 handle for the first time in a while. Let's just put that onto the 4-hour chart, just get a better description. As you can see here, even the daily chart, you can see how progressive we are looking at the moment. And what I've put in here is just a slight support line that could be hit, give or take where it is at the moment. And we could be hitting that roughly as we head down to the middle of the 109.50 range as well. So with that being said, this jobs report, if it is a good one or a decent one for the American economy, then we're expecting another leg lower for the euro dollar pair, especially. So economists are expecting to learn that there is over 400,000 jobs being added to the American economy, and a key indicator of price pressure, rose 0.5% month over month. But the thing that I want to get into just before Daniel connects with us is Jerome Powell and his statement in the recent Federal Reserve meeting, which happened recently. He's saying that he wants to increase the Fed rate by, a few basis points. He's looking at a very, very strong recovering economy for the last few months. So there's no reason that the central bank would keep on doing an accommodative monetary policy. So again, with that being said, is this going to affect any of these dollar pairs significantly? I just want to pull up the US index now. It's hit the 98 handle for the first time, as you can see here, for the first time in 18 months, which is quite significant. So we're seeing literally almost pre-pandemic levels. This was May of 2020. So that's when the pandemic was really starting to take effect on the American economy. Since then, as you can see, a big V-shaped recovery. It has taken a while, but it's a very good sign of the American economy getting back on track as well. But the idea of raising interest rates is to keep those current and persistent predicted prices under control after, petrol and food supplies in prices have gone up quite significantly in the last few months. And it's actually not even the American economy, it's all over the world that prices have actually started moving higher. And obviously oil prices are at yearly highs as well due to the Russia-Ukrainian conflict. And Jerome Powell did actually touch upon that as well, saying that it might be a big effect on the monetary policy if this continues as well. So the next meeting is scheduled for the middle of the month on the 15th and 16th of March. And then we'll see more indications of if we will now start moving to another move to the upside, and we'll see what's going on there. I just forgot to tell you that any questions you want to direct at me while we're doing this live stream, please feel free if you need to. Anything that's any of your own suggestions where you think any of the forex pairs are going, or any commodities, we'll go through them one by one. So gold as well, I'm just looking at obviously the ascension in gold since the conflict started, the unfortunate conflict started. So we had this big move to the upside, very, very nice double top here. And then double top's obviously an indication that prices will start falling lower, and they have done, but this was quite dramatic. In less than a day, we saw a move of nearly $100 to the downside. But as you can see now, we're moving in a nice trend to the upside, and we'll see how far that's going to take us, because it is looking very, very bullish for gold at the moment. So 1940 trading at the moment. There's no reason why we can't go 1950 and then start testing these recent tops here, 1950, and then up to the double top at roughly just over 1970 as well. So this is something that we are looking in the near term. And as I said, with Jerome Powell's testimony, we're looking at the next Federal Reserve meeting. We're looking at the predicted job numbers as well, and also what's in store for the next 6 months going into 2022, going into the summer. Obviously, with the Ukraine and Russia conflict, it's not obviously it's not very appeasing to the markets at the moment. A lot of opportunities to be made, though, unfortunately, of this devastating news. But gold and oil, obviously, very, very predicted. Gold pushes higher during uncertainty, safe haven for a lot of traders. And obviously, oil was going to start moving dramatically higher because there could be a sanction. Well, there are sanctions on Russia, meaning that a lot of European countries, and it might hit America, will not be extracting so much oil and gas from the country. And the pipeline that's going to a few of the European countries from Russia has been put on pause as well. So this is obviously the reason that natural gas is flying higher at the moment, and oil as well. So with that being said, let's just take another look at what's in store. We'll put this on the big screen. So at the moment, as I said, analysts expecting a slight decrease to 400k, but it's not looking like it's going to be too worrying for the economy. And the unemployment rate is still expected to be similar, but the lowest since February of 2020. So as you can see from the NFP figures here, we are looking for another leg to the upside. These are just charts, obviously, so it's not very, very predicted like a MT4 chart, but we are looking for another move higher by the time we get into the summer. So this is by the time it comes to June, July, the American economy is supposedly, very, very buoyant, getting back into a recovering economy. And then this will obviously spur on jobs as well, ADP jobs and jobs in general. As I said, I just want to take a look at the annual inflation surging up to 7.5%. You know, a 40-year high, the highest since 1982, and it doesn't look like it's going to slow down at the moment. We are looking to see what the next move is from Jerome Powell. You know, the CPI data that's been coming out, pushing prices higher and higher. The cost of living is jumping higher and higher as well. So the inflation that they're experiencing is nothing like we've seen in the last few decades. And at the start of the pandemic, the Federal Reserve obviously slashed rates to zero in a bid to stimulate spending and the economy at a time when a lot of sectors were closed down as well. So it's looking like it's going to be persistent, but obviously not too worrying. So back to MT4 chart, just want to take you to cable because cable is quite interesting. I've been tracking this sideways pattern until we saw this very, very sharp decline on cable, a very, very strong dollar. And again, this was not really a big time frame. This was roughly a few hours and obviously dropping over 300 pips in just a matter of hours. That was a very big downturn. But since then, just looking at this side, another sideways channel that it's in, and as you can see now, it's actually pierced this channel. So what I'll be looking at here is if we have pierced support here, we might be heading for another downturn. So let's just put that onto the daily chart just to get a better significance and zoom in so it's a little bit easier to see. So as you can see here, this is the levels that I'll be looking at. But now that it's pierced it, then I'll be looking at these recent lows here, roughly around the 132 handle. Trading just at 132.60 at the moment. So another 60 pips to the downside isn't really something too unthinkable, especially with the non-farm payrolls coming up in just over 15 minutes. So we'll see what's happening in the near term as well on cable. And just to look on the Dow as well, got a lot of traders with Orbex, very, very interested in the Dow. And I'm always looking at it as well to see what the opportunities are. Since we had this big gap from the market open at the beginning of the week, we are looking now, let me just double check. Yeah, from the beginning of the week. So we are looking now that it was slightly recovered, but hit a very hard resistance at the last price. This was last Friday, as you can see here. And then a nice sell position was, I put a nice sell position in there because I didn't really think that it's going to start spiking higher, and it didn't. It collapsed quite significantly. Then we had another test to the upside, and as you can see here, a couple of false breaks and another leg to the downside. So the trends at the moment are very, very predictable. Always look for these kind of trends, and especially if there's a weekend gap that's quite large due to the Ukraine-Russia crisis. A lot of the markets gapped on the open on Monday morning because of all the tension, all the news coming out on the weekend. But when these markets have these gaps, it can be very predictable to trade. So just keep that in mind when you are looking at some trades as well in that respect. So as I said, very, very easy move there, and then another move to the downside. So if prices still do start moving up for the Dow, just keep an eye on this 34,000 approximate zone, 34,100, 34,050 area. Wouldn't go far down as 34,000 round. That's a little bit too far down, just a little bit higher for me, where we saw a few spikes. This looks to me like a bit of a false break, and now we're moving to the downside again. So looking just very, very bearish at the moment. Dollar CAD, like I said before, we've got the Canada's PMI coming up later in the session, a couple of hours after the NFP. So this will be something that we will be seeing in the near term as well. And, you know, this V-shaped recovery that I saw in the last session, we are now looking a little bit more bid as well. So if I just zoom this out a little bit, again, from the market open from the beginning of the week, we did see this gap emerging right here. So as you can see, the market continued to push higher, but then it quickly closed the gap as well. So anytime there is a gap in the market, look for this retracement or sharp reversal to the downside. And again, as you can see here, the levels at the moment are the levels that are trying to complete this gap, but are failing. And now we are pushing to another leg to the upside. We have broken this line, but as you can see, we're moving a little bit lower. So just keep an eye. If we break and stay above, then I'll expect the dollar CAD, the loonie, in other words, to start moving higher, as well as we'll see if that's going to start moving into the next few moments as well. So just over 10 minutes until the news is released, and as I said, any questions that you like to add on the live chat, just let me know. So just going back to a few statistics at the moment. When it comes to the Federal Reserve, as I said, going up by 0.25%, which is 25 basis points. ISM manufacturing and employment component was down slightly, and so was the services component as well. As I said, ADP jobs showed 475,000 new jobs, and we are looking that the US labor market is still a little bit uncertain, but still very, very buoyant as well. And we'll see what happens shortly with that. So going back to the euro dollar, as I said, for me, if we start touching this particular channel here, we could see another move to the upside. And that can be very, very, very detrimental for a few of the dollar traders, but can be predictable as well. I'll just be seeing if it starts moving lower or moving, bouncing at this particular line, if we're going to start moving to the upside as well. So a couple of things to take into account that I always give a few trading tips when we're doing the non-farm payrolls is obviously don't risk more than your risk capital. So don't go into the such a heavy, high impact fundamental news event if you're risking too much of your capital. Also, make sure that you are comfortable with doing certain trading styles, such as hedging, such as scalping. Obviously, the whipsaw effect with the NFP on such a high fundamental news event can be very, very dangerous. So if you're uncomfortable trading these big events, then just stay out of them altogether, and then you'll be safe not to have that kind of risk in the meantime as well. So just over 10 minutes now until the until the news is released. I'm just checking all my data here just to make sure I'm not missing anything. And as I said, we obviously don't always take the NFP on its own. We've got the average hourly earnings, we've got government payrolls, unemployment rates as well. So we're just looking, these have been updated at the moment. So now we are looking at still around 400K for the new jobs added, which will be 67,000 jobs less than what we had from the previous round. However, it is still looking pretty good for the American jobs market. Average hourly earnings looking at 0.7% from last time around. We're looking at 0.5% this time around. So not too much in the way of a drop on average hourly earnings. And this is monthly, by the way. And non-farm payrolls private is looking slightly down as well, but still above the 350,000 zone. So again, still looking like it's going to be pretty good in the near term as well. So let's take another look on the charts then. So basically, I'm just tracking this euro dollar. Very, very excited about to see if we're going to move into this territory. And the 4-hour chart gives me a little bit more clarification there. As I said, pound dollar, again, just looking to see what's going on with that, because we've dropped out of this channel now that I was looking at progressively, and now we're going to see if there's going to be a bounce to the upside as well. Dollar index, very curious about the dollar index, because we've gone over 98, we're pushing towards 99, and if we get that magical number of 100, then the sky's the limit for the US index, because that will signal a very, very good recovering American market. And in doing so, we're looking to see more and more upside in that respect. So let's see what happens here. So, I mean, if we're looking at levels at the moment as well, I'm going to put in a level of 99 round, because this will give me a good indication of, a very good move to the upside. Gold as well, the 1950 handle for me is something that I'll be looking at as a resistance zone. You can see these nice spikes here, heavy resistance, and now falling lower. But if we're going in an ascending channel, then there's no reason that we can't actually start moving higher in that respect. So again, I'll just pull this a little bit forward just to give you a target of what I'll be looking for. So obviously this is my own analysis. Your analysis might be a little bit different. Obviously, you can contact me in the chat if you have any other of your own clarifications or estimates for the levels that we're looking at the moment. But for me, we're looking at this ascending channel since we had this vast drop on the gold not so long ago. The Dow as well, as I said, looking at heavy resistance at this particular area, just over 34,000, and then moving lower as well. I believe this particular area here was a little bit of a false indication that the prices will start moving lower. For me, this didn't happen. And it predictably went back up again to test these recent highs. So if we start moving to the near term, then we're going to start looking at what's going to happen for the rest of the trading week, going into next week as well. And obviously we're starting a new month and going into March. End of the quarter will be quite significant as well. We're looking at a very positive earnings report for the first quarter of the year, but now we're looking at the next quarter as well. So we're seeing if the big guns in the S&P, NASDAQ, and the Dow Jones are going to start moving higher as well. So just over 5 minutes until the news is released. And just take one last look on the loonie before we get into it as well. So dollar CAD, we usually have some big dollar news as well. And I see Daniel's joined me. I'll just put on my headphones so I can hear him. Hi, Daniel, can you hear me? Let me just adjust my speakers. Hi, Daniel. Can you hear me now? Okay, I can't actually hear you at the moment, so I'm just going to have to just adjust my settings. Is it possible you can check on your side? I just can't seem to hear you. Still nothing, unfortunately. Could do a quick test on my speakers just to see if I can hear myself or not. My headset is working, but I can't hear you for some reason. Sorry, everyone. This is a live webinar, so obviously little technical things can sometimes go a little bit wrong. I'll see if we can get the speakers to work if possible. Daniel, can you hear me now? I can hear you.
Oh,
yes,
okay.
You can. Okay.
Fine. Do I sound really far away? I think I have two microphones connected at the same time, and they're interfering with each other. Sorry about that.
No problem at all. Apologies. So thanks for joining me. I was just taking our viewers through a few of the technicals and where we stand, and also a little touch on the Fed's, Jerome Powell's comments recently that he wants to hike the interest rate by 0.25%, 25 basis points, and where that could lead the American economy as well.
Oh, right. Yeah. Well, I guess to fill in, I don't know if you mentioned that the range of expectations is 250,000 to 700,000.
Yeah.
Which also could be contributing. But really, the only thing, because we're kind of short on time, so sorry.
No problem. We've got a few minutes.
Yeah. I just wanted to mention that because, the whole Ukraine thing, I kind of expect that the results aren't going to be really changing the market all that much because everyone's, the risk profile is over in Europe. And unless there's something really special comes out of the non-farm payrolls come out now, I would expect it to be kind of more of a muted market reaction. So, of course, you shouldn't be too sure about the future.
Exactly. I was just mentioning that to our viewers because at the moment, I'll just take you to the euro dollar chart, for example, and we're seeing this quite progressive decline in the euro dollar. So obviously indicating a strong dollar at the moment, but when the results are released, we might have a bit of a non-performing payroll because of, like you said, the conflict between Ukraine and Russia at the moment.
Yeah, it's also pushing down the yields in Europe. Everyone's moving towards safety, and so you'll see the euro probably will underperform a little bit more than the dollar, and people would prefer to be a little bit further away from what's going on in Europe.
Exactly, yeah. And just to touch upon gold and oil, because they've been moving very, very bullishly for the last few weeks because of the conflict. Do you see a little bit of a slowdown in these commodities, or is it still going to be quite a massive progression if this conflict keeps going?
Oh yeah, the concern is we still have this issue with oil in particular that there are a lot of Russian companies are unable to actually sell their oil. There's a lot of the buyers are preferring to buy from someplace else because they don't know if further sanctions are going to be applied on Russia, or Russia will cut off its supply as part of a geostrategic move. So they're actually paying up to a premium of $20 per barrel to buy from someplace else that isn't Russia. So as long as that threat is kind of floating around there, whether people are not sure that Russia will be able to make their deliveries within the next month, we could probably see the price of oil staying higher. But it has been coming down since, when was it? I think it was on Wednesday, it reached a peak. Brent went up to $120 a barrel, I think it was. And since then, it's been kind of floating down. I think they got a little bit too ahead of themselves there.
Yeah, I mean, when we hit the $100 barrel mark, it was quite significant. But then when it shot up to 120, I think it just kind of like got ahead of itself. And then we saw that retracement.
Yeah, the market does tend to get a little bit overexcited, then come down for a correction, but that doesn't mean it might not pop back up there depending on what happens.
Exactly.
We had the conference or meeting between Ukraine and Russian representatives yesterday, and it didn't really reach any kind of conclusion. They're going to meet again on Monday, and so then we have the whole weekend when a lot of stuff could happen, and without any possible situation that would resolve the conflict and resolve the risk aspect there. I'd expect.
Yeah. Okay, so I'll just interrupt you there because I'm just getting the
Oh,
live
sorry.
feed now for the news coming in. So the NFP has come in at 678,000 jobs, new jobs this month. So, for the last data. So it has cleared the 481,000 that it did hit last time around, and
near
obviously
the top of the range.
Yeah, exactly. And obviously beat the market expectations of 400,000. So quite significant there. And just looking at the other things as well, we've got average hourly earnings monthly coming in a little bit down at, 0% actually. So nothing unchanged there. And just looking at the unemployment rate as well is at 3.8%.
3.8%. Yeah.
So it's dropped a little bit there. So would you say that this is it's a pretty good jobs report then this time around, Daniel?
Yeah, definitely. We're still looking at a couple of the components to see where the extra amount came from. And we, of course, had the drop in the unemployment. I think kind of more the key here would be the average hourly earnings not going up, because the thing that the Fed is really worried about is inflation right now. And so if you don't have, they're really worried about that inflation, wage price spiral that could cause increased inflation. But if you see wages aren't going up so much, they might not be as worried about that, which could have a more hawkish bent to the Fed. They might give the conclusion of the increased number of jobs added, plus the drop in unemployment, plus the slow increase in average hourly earnings, kind of all point to the Fed would have plenty of room to raise rates at the next meeting, potentially the 50 point. But I mean, I suppose Powell kind of sort of threw some cold water on it. There would be 50 points in the next time, but it's still open. I would expect maybe some people to reevaluate whether they expect it to be a 50 or a 25 basis point going forward.
Well, yeah, there is that as well. But there's also the fact that he said it's not going to be the only hike of the year. There's going to be probably 4 or 5 going into 2022. So by the time we get to 2023, we could see probably pre-pandemic levels, perhaps.
Yeah, the market the last time I saw it was pricing in about 7 rate hikes. So that would be in total up to 1.75 interest rates, if I remember the calculation correctly. So yeah, that would be close to but that would be really significantly tightening and really fast tightening of the and the amount of funds that are available. So I don't know how the market's reacting to it. Probably, I guess it's still within the range, so the reaction might be a little bit more muted as we expected.
Well, yeah, there is that, but the Federal Reserve Chairman Jerome Powell just say, there's no longer the need to accommodate this monetary stimulus and this monetary policies, because he looks at this recovering market for 2022. So that's, you think of leisure, travel, tourism, the whole 9 yards. Is he getting a little bit ahead of himself, or is it something to be optimistic about as we go into the year?
Well, yeah, I mean, definitely, particularly for the United States. Again, it comes down to, I guess, the risk profile. Maybe not to be the broken record always talking about Ukraine. I guess everyone's kind of tired of hearing that. But again, the United States is much more disconnected from that than Europe, and so you have increasing the pandemic restrictions are essentially going away now. So this pent up demand for travel. So you would see an increase in consumer spending probably. And so, the Fed would definitely need to take an issue in there to stop it from going up too much.
Okay, then great. So, and just touching upon this Russia-Ukraine crisis, a lot of sanctions have been put on Russia, and obviously the world is following suit. You heard Joe Biden in the past few days, he's putting sanctions heavily on Russia, and obviously their relationship is going to be a bit crushed now for the next few years at least. Do you see that impacting the American market in any way? Because we know that. Sorry, go ahead.
Sorry. No, I mean, whenever you do a sanction on another country, of course, it has an impact it impacts both sides. And the idea is that you try to do a sanction that has more of an impact on the other side than it does on your side. But the United States has carved out like their key things that are most important for their own economy. They're not sanctioning steel, they're not sanctioning oil, and they're not sanctioning titanium, which is important for the aviation industry, obviously. So far, the amount of effects for the United States are probably relatively limited, but we just heard earlier today that the Biden administration is considering another round of sanctions, and there's also a bill going through Congress that's trying to put pressure on the Biden administration to actually sanction oil or stop buying oil from Russia. So there's still more things that could come out, and a lot of this is kind of politicians reacting to public pressure. Because if we consider the original reaction from the politicians was to sort of have a more stand back position, and then we had a more popular reaction, and then the I would say they started taking stronger measures. And so as popular support maintains the popular support for measures against Russia, we might see more sanctions coming out. And that's kind of the thing that the market's probably pricing in with their risk, is because when you have politicians trying to appease a population that's demanding something, you don't always know what the politician is going to do. And so that then increases the risk profile, I would say.
Well, yeah, because you have to think that when he had the Afghanistan crisis, when he pulled the troops out, he didn't really give any Q&A, any questions or answers about it. It was just a quick, swift move. I guess this time around, he had to come out probably all guns blazing to show that he is this determined president that's looking out for the best interests of America, really, and the world.
Yeah, exactly. If you compare to the Afghan situation, he has a strong motivation to be harsher now than in to sort of compensate for what is perceived as weakness in last August.
Sure.
So that can also play into a factor. It just keeps adding on to the uncertainty, and and markets, of course, hate uncertainty.
Of course, yeah. I was going to say there's only a couple of years before we have the next election as well. So I guess most of 2023 we'll start seeing the candidates start appearing, and then as we go into the next year, we'll see another round of elections. So we'll see how popular Joe Biden is then.
Authorities are going to be paying a lot more attention to the polls this coming year. But that also generally, when you have an election year, you have kind of a more positive outlook, because the government is trying to do everything to keep the economy going, to keep people happy, so that they will go and vote for them. So it does help for the overall outlook for the economy. But I mean, right now there's the serious problem with inflation, and what exactly the Fed is going to be able to do about that.
Exactly. So would you say all eyes are on the Fed for the next few months, as they say the next hike is coming and then the next hike is coming?
Yeah, pretty much. I mean, I guess for the short term right now, everyone pretty much agrees that the Fed is going to raise rates at the next meeting. So it's sort of like a foregone conclusion. Then the question is going to be, well, what did they say after? What kind of guidance they're going to give after that? So I think like the next meeting could be relatively quiet in terms of monetary policy, like in terms of the market reacting to monetary policy, I should say. And then when the meeting comes along and then Powell gives his speech, then it could react a little bit stronger after that.
Okay, then great. That's great, Daniel. And just a final thing I just want to touch upon. We've had such a progressive earnings season at the start of 2022. All the big players have been, exceeding Wall Street expectations. Do you see this going into 2022 as well? Obviously, the next earnings season is going to be upon us before we know it. Would you say that it's going to be still progressive as we go into the year?
Yeah, it seems to be like, at least going through the comments of most of the CEOs, they said that they have a pretty positive and bullish outlook for the year. But they all kind of repeated some of the same things that they were worried about. Inflation, inflation, if they can't pass the costs on. So they have the problem of passing the costs on to the customers. And so probably we would want to take a close look at retail sales going through to see how the companies are going to be able to perform, because if you get a loss in consumer demand, then the companies aren't going to be able to raise prices, but the raw material cost is going to keep going up. And so that could start putting pressures on the margins. And then maybe in the second half, we could see the results, they might have to start cutting their guidance a little bit, and that might depress the market. So, I guess Fed and retail sales are two important things to keep an eye on. And also the level of debt, because if they start raising rates, there are a lot of companies that took out debt during the crisis period, to be able
Yeah.
to make it through.
Mhm.
And now, depending on the kind of debt that they took out, the increased cost of capital could end up affecting them as well. So it's something else to keep in mind.
Yeah, you just reminded me to touch upon retail sales actually. Before you joined the chat, I went through on my presentation. I'll just jump it up for you now. Sorry. So the retail sales, it's just been jumping in and out of negative territory for the last few sessions. But we've seen this jump most probably due to the holiday season in America.
Yeah.
But does that mean we're going to head for another negative territory next time around, do you think? Or would it be pretty balanced going into it?
Well, of course, that's a big question. I think a lot of that ups and down that you have in the retail sales depends on sort of the fluctuation of confidence that consumers had because of
Mhm.
COVID. You have you had that big rise there in February, which is when the COVID cases were dropping last year, and
Mhm.
then in May that's when we started hearing about the new Delta variant. And then, of
Mhm.
course, in December, that's the leftovers from the new Omicron. It started making news right after Thanksgiving, if I remember correctly.
That's right.
Was
Yeah.
yeah. So a late November, and then you see that impacted in the December number. So presumably now, if Omicron is, as everyone thinks it's going to be, spreading around everywhere, but giving people mostly immunity, plus all the people that have been vaccinated, hopefully then the COVID situation will peter out, and then we'll get more stability.
Mhm.
Though, kind of, I guess, a historical note, if we go back to, because a lot of people are comparing it to the pandemic in 1918.
Mhm. Yeah.
No, yeah,
Was
1918.
it 1980?
And
Yeah.
yeah, it went through a similar pattern. It was essentially 2 years. You had it came out in March, and then you had one serious winter, and then you had a second winter, and then after that it was gone. And so we've done that basically again. But now, of course, we have vaccines, and back then they didn't have vaccines. So if it
Of
follows
course.
a similar pattern, of
Mm.
course, history never can say exactly what's going to happen in the future, but there's an antecedent to it.
Well, they said history does repeat itself sometimes, but hopefully not in this
Yeah.
case. And
Yeah.
well, we've had the UK Prime Minister Boris Johnson did say, I think it was this week or last week, starting this week or last week, that UK citizens will just have to learn to live with COVID, and restrictions do have to be fully lifted because
Yeah.
the governments and economies have to get back to pre-pandemic levels and just get on with it. Obviously, lockdowns, restrictions, these kind of things, I guess they have to be a thing of the past sooner rather than later.
Yeah, for most of Europe and in North America, South America. Well, but there is a thing, of course, with China, that they were managed to keep the pandemic at bay for a really long time, right up until
Yeah.
Omicron came out, and now
Hmm.
they seem to be having quite a bit of problems, particularly in Hong Kong. They had to close. They closed the legislature. There've been banks that have been having to close. So we might have a final spread of the virus through China, which could also have a negative impact on the economy,
Hmm.
because that was originally what happened in the first time that
Yeah.
what was it, in the beginning of 2020, that was said to negatively impact the economy, the global economy, by up to a couple decimal points, and so that might also then exacerbate the supply chains, but it'd probably be over relatively quickly. Same thing with how the Omicron variant was in other places.
Hmm. Okay, great, Daniel. Great insight there. So I just want to quickly go back to the charts where we've got some time. And,
Mhm.
we've, when we said a bit of a non-performing payroll, we can see at the moment from when I'll just zoom in so it's a little bit easier to see. So when we've had the news result, we've only moved roughly about 30 pips. So,
Yeah.
for such a big increase. But the thing was, what I was tracking is we had such a big move during today alone that maybe it just kind of petered out. We've had roughly over 100 pip move today on the euro dollar. So could you say that the news kind of happened before the NFP release, would you say?
Well, I think it is what I was saying before about how the geopolitics situation is kind of overshadowing the economic data
Yeah.
right now. So
Hmm.
you have the geopolitics things push it 100 pips, and then you have the data pushing it 30 pips, and it's sort of like, it just shows the magnitude of the difference. And also I think it doesn't really change the underlying calculus, because the Fed, everyone's probably believes the Fed's going to raise rates, and that's what the main thing for the non-farm payrolls is how is it going to affect monetary policy. So yeah, I figured that really even through next week, everyone's going to still be focused on the Ukraine thing. Probably we're going to have to get used to hearing a lot about it for a while.
Yeah, I think the market at the moment is very fundamental driven. I mean, obviously, Ukraine and Russia's moved the market quite significantly. We've got the Fed monetary policies and stuff like that. That's moving the dollar pairs as well. So I would say, probably throw the technicals out the window for the next couple of weeks.
Yeah, probably.
Just keep an eye on the headlines mainly.
You never know when something like is going to happen. Like last night when they had reports that they were shelling a nuclear power plant, and then everyone got really concerned. That is something that technicals really can help you with, and even fundamentals to a certain extent. Who would think something like that would happen? But that's what it's like dealing with the markets. You have to be ready for risk and get your positions well protected.
Exactly. That's what we tell our traders quite often, to make sure you have the correct stop losses and even take profits in place, because a stop loss obviously stops your losses, but a take profit can stop you from going over that threshold and making sure you've got that profit locked in place. So you don't get too overexcited about such a big move. Because if we just go back to the gold chart quickly, Daniel, while I still have you, we saw this big detrimental downturn in gold, over $100 in just a matter of a few hours, and that was just that's when we had the peak, when the war did start happening on the 24th. This was just over a week ago. So as I said, over $100 move on gold. But as you can see, the trends at the moment are showing that there's a nice ascending channel. But I'm seeing a bit of resistance at 1950 after we've seen these recent peaks here. So for me, I'm just seeing if we're going to fall out of this channel and start progressing lower, or if there's a chance that we could hit this 1950 and possibly start moving to these fresh highs that we saw at the beginning of the invasion, roughly just over the 1970 region. So with gold, obviously, it's a safe haven for a lot of traders, but it's, during the course of the pandemic, as you well know, we hit fresh highs again and again and again, over 2,500. So, I'm still kind of looking for those kind of levels in the near term, at least, or medium term, at least.
Yeah, exactly. I mean, the fundamentals for gold still are kind of pushing to the upside as well. So, if it can manage to break through that resistance level, well, who knows where it's going to go after that. But as long as we have everyone's trying to find some place to store their value. So I think that seems to be a good option.
Okay, great. Well, that's great, Daniel. So thanks for joining me today. We're just going to wrap up the presentation now, just telling our traders and viewers that we're going to be going ahead with this kind of scenarios for the next non-farm payrolls for the foreseeable future. So any questions or any agreements or disagreements you might have with our technicals or fundamentals over the chat, feel free to let us know, and we'll be sure to make sure that this is a regular thing, more interaction with our traders to make sure they're getting the best bang for their buck, let's say, and and they're not missing any of the fundamental news when it's released, and also the technicals as well. So Daniel, once again, thanks again, and we'll make sure the speakers are working next time around when you connect.
Yeah, at first time there's always a little bit of a technical difficulty, but now we got it worked out.
Exactly, and that's how we prove to our traders that it's a live webinar as well. It's not pre-recorded or anything. So
yeah, that's a good excuse there.
Exactly, it's a very good excuse. So remember that for next time when the camera goes off or something as well.
Yeah.
Okay, Daniel. Once again, thanks for joining me, and I'll catch you next time.
Right then. Thanks for having me on. See you around.
No problem. Thanks a lot. Take care. Bye for now.
Bye.